So good morning, dear friends.
Good morning, sir.
Okay. So what I thought was I am preparing some questions. So morning, these two sessions we will treasury, and the last session evening we will discuss some questions and all your doubts on both treasury and IB. Some questions I am preparing. Okay. So they'll together both treasury and IB together we will discuss. That will be fine. Okay. So as you know, the treasury, that conventional treasury's function was funds management, liquidity management, CRR maintains, and asset liability management of the bank as a whole. Now that integration of the treasury, which brings together both domestic treasury and forex treasury. Forex treasury, the possible question they can ask is, what is FEDI? The study we have seen, Foreign Exchange Dealers Association of India. Their organizational status is self-regulatory authority. Similarly, corresponding self-regulatory authority for domestic treasury is FIMDA, FIMMDA, Fixed Income Money Market and Derivatives Association. Corresponding to FEDI for FEDI is for forex treasury, FIMDA is for domestic treasury. The objective question they can ask. And now the integration of the treasury, that is both domestic and forex treasury together, they are dealing in all the three markets. What are the three markets? Liquidity market management in the monetary market, money market, forex operation through the forex market, security management through the debt market. So the interchanging, suppose the bank is having for a surplus forex funds, assets in forex that can be swapped to rupee through this bond market or something. This can be shifted to bond market, or it can be sold realized swap to INR fund that can be invested in the money market accordingly. Suppose they have surplus liquidity is there, that money can be shifted to investments through bonds or debentures that can be invested in this market. Or if forex market is attractive, this can be swapped to dollar and that can be invested here. So the integration actually is the treasury is now handling all the works connected with these three markets. Beauty is interchangeability. Smooth as possible, the interchanging can be done and the funds can be best profitably invested for the bank. So that is the main factor. Next is the possible questions are statutory rates. Two rates are there. One is statutory rates, as you know, CRR and SLR. And the policy rates are repo, reverse repo, MSF, and standing facility. And here the question they can ask is present rate. Rate they are not asking. So simple that they are not asking. Only for JAB they are asking. And the section you can familiarize. 40th of RBI Act. That you should not confuse. That is always I say CRR RBI Act. This R and R you can match. So that CRR will be for RBI Act. And this is ultra SLR is 24. This ultra 24 of banking regulation. And the daily minimum is 90%. Minimum at least 90%, but an average fortnightly they have to maintain 100% of. 100% of what? 4.5% of the net demand and availability. That is to be calculated for CRR. That is in the note. Please familiarize that note once. IBS note, it is there. Just what is the net demand and availability applicable for CRR? Just familiarize and give concentration, give some importance, attention for exclusion item. What are the items to be excluded? Just need not by heart it, just go through, that is enough. And this is the benefit of 90% is only for public sector banks. For cooperative banks, they have to maintain 100%. That is on 100% of what a daily maintenance is 100%. Another thing is The cash, whatever it is in the ATM, can be reckoned for CRR. That benefit is for cooperative banks only. And these changes, earlier CRR and SLR, this calculation of debt ETL was different. And through the circular, now it is both the same, one at the same for both SLR and CRR. And for just knowing that, just quickly we see, actually we will just take the example of a fortnight, 23 to 5. This is a fortnight, 23 to 5. For that fortnight, the relevant CRR NDTL will be as on 8. That is last Friday of the second preceding fortnight. So 9 to 22 is the first preceding fortnight, and this is the last Friday of the second preceding fortnight. Now that both for CRR and SLR, this is a common. So the CRR for this fortnight should be maintained based on the last Friday of the second preceding fortnight. So that is a common. Same for CRR and SLR. Earlier it was different. So in CRR only
Sir,
those things.
CRR is for the one leg basis, no? One fortnight leg basis.
No, that is changed. Through the circular it is, now it is common. Earlier it was one leg, now it is not like that. You will get a benefit of gap of one fortnight. So that is a change that has come through this circular. So that is why I have put the number of the circular. Now for CRR and SLR, you will get a gap of one fortnight. That is in short. And another question is, what they can ask is, CRR maintenance is a prudent function, because if you are maintaining any extra fund, you will not get any interest. It will become idle fund. But if you are maintaining a lesser amount, that is penalized. That is, you have to pay penalty on it. The penalty working is, they can ask 3% above this rate, bank rate. This bank rate is 6.15 at present, 3% above bank rate, that is 9.15 for the first day of default for the amount of default. You have to pay the penalty of 9.15 for the first day only for the amount of default, and the default continues, that will be 5% above. 5 plus 6, 11.15 TDDs. Here one point what you have to bear in mind is, it is not the question of financial loss. Because for a big bank, all the banks are running, have got much funds with them, and the payment of this few lakhs or something is not that matters. But the problem is the compliance risk. That is, you will be getting affected. Reputation risk is the most important thing. The bank will be affected. As you know, it will come in the papers and all, it will be damaging the name of the bank. That is the more concerning factor. So that is about CRR. And the possible questions in SLR is, number one, the rate they will not ask, section they can ask. And how it is maintained? By investment in government securities, that includes both state and central government, and also any other approved securities approved by Reserve Bank of India for the purpose of SCL. Example, say KSIDC, state government, KCB and all, they will allow, because that is the payment of the interest and the principal is guaranteed by the respective governments. So then RBI will declare them as an approved security for investment in SLR. So then banks will subscribe. And so three things. One is government investment, government securities, and any other securities approved by Reserve Bank of India. Number two, investment in gold. Number three, branch cash balance. These are the three items that is permitted. Now, additional fourth item is, you see in the repo, the policy rates, one standing deposit facility is there. Now, the bank can deposit under the scheme with Reserve Bank of India. The Reserve Bank is just like a deposit. That way, this name is deposit, 5.65%. They will give interest. Whatever that deposit you have placed, that also can be included under SLR. So now presently 4 items: investment in government securities, investment in gold, branch cash balance, if investment in SDF, if any. Then coming to this policy rates, there is a policy rates, the liquidity adjustment facility. That is it. Actually, this applies for the Reserve Bank of India. It is selected. It is applicable to all the banks and selected financial institutions only. RBI will extend this facility. Wherever those institutions want to adjust their liquidity, RBI has got two tools important. That is not two tools, these are the tools. Repo, reverse repo, MSR. Repo is this temporary borrowings the banks can make. Major banks plus selected financial institutions, they can borrow from Reserve Bank of India at the 5.90. But merely the RBI will not give the fund. They have to collateral, they have to give the government securities kept in this SGL account. I forgot, I will tell. The government securities are now this demat form, dematerialized form, non-physical form. These are all kept in the SGL account. This also they will ask in the examination. Subsidiary general ledger account. What is this account? They can ask. So subsidiary general ledger account is an account maintained by the banks with Reserve Bank of India for crediting government securities in demat format. And they can ask what is CSGL. Suppose a bank doesn't want to keep an account, maintain an account with Reserve Bank of India for this purpose, for keeping the SGL securities, they can open an account with another bank or agencies like CCIL. That is known as CSGL, Constituents Subsidiary General Ledger Account. So these are two different accounts. Purpose is only the same. Mostly they will be asking for the exam. So coming back to this repo, so the bank can make temporary borrowings under 5.90. Then what is eligibility? Eligibility is they have got 1% of the net DT, demand and liability is eligibility. Even if it is 1%, it will run to crores. Out of that 1%, 0.75 is the 0.25 is the overnight eligibility, and let me yes, 0.75% is the 14-day the term repo, and 0.25 is the daily, means overnight repo. Out of the two-way, that 1% of the DTL which you can avail by repo, 0.75% will be for the 14-day repo and 0.25% is for the overnight repo. That is a eligibility. Then once you pay that, the interest on this is adjusted on the securities you deposit as collateral and the rate at which they give back the security. So that is an operational style they fix it. Reverse repo is surplus funds with the banks can be kept with Reserve Bank of India under the scheme and we will be eligible to get this 6.35%. Here also the RBI will be crediting the SGL account with the corresponding security, and when you get back this amount, you take that amount from RBI, the security should be returned back. This is how repo and reverse repo. The questions are, what are the tools for the Reserve Bank of India for maintaining liquidity adjustment facility? These are the two tools. And this another point is the repo, the limit of 1% is only for Reserve Bank of India, and any other repo and all, it is not applicable, because I am a State Bank of India. I got some surplus securities. I can do with CCL also. There the limit is not there. There the term that 14-day also is not there. Normally the repo other than the Reserve Bank of India is normally for 1 year. What is the MSF? Because the bank rate, because after the inception of the marginal standing facility, the bank rate has become redundant. That is why now both has got the same 6.15%. Here the important point what you have to observe is, you see this is also a borrowing, MSF also is a borrowing. Both are borrowing from Reserve Bank of India and we have to pledge the securities. But here you find that rate of interest is more. So only unless you are badly in need of fund and you have exhausted the repo eligibility of 1%, still then you are having short of fund, then only the bank will resort for 6.15%, because this is a huge interest that you have to pay for Reserve Bank of India. But here also we have got to pledge the securities. But unfortunately, the only benefit that you get it, suppose you have to pledge the security for availing MSF. When you pledge the SLR security which is maintained in the SGL account, it will come down. This 18% can come down. If it comes down up to 16%, that is what we call 2% dip, we need not pay the penalty. That is the only benefit of availing MSF. This is very important. I will repeat once more. Because of availment of MSF, if the SLR percentage dips up to 16%, there will not be any penalty. And if it goes below 16%, same penalty of CRR applies. 3% above bank rate for the first day of default, 5% above bank rate for the remaining days. That continues. Then we have just we said the NDR calculation.
Once repeat on a computation of CRR on fortnightly basis, sir.
This is a fortnight,
yes.
23 to 5. For this fortnight, you will get a gap of 9 to 22. One gap will be there. That is what we call second preceding. Okay. Earlier, these were different. Now that for both CRR and SLR, it is one at the same. For 23 to 5, you have to calculate based on the NDTL of 8. So you get a benefit of 1 fortnight, 9 to 22. This is a 1 fortnight. So that is, you will get a gap of 1 fortnight. That is in short. Okay?
Okay, sir.
Earlier it was different. So I have the circular and all, I will share this. But you need not go for the circular and all now. Just study this markup or just familiarize, that is enough. That this is just to show the sample how this is worked out. The CRR I told you is fortnightly basis. Suppose the pertinent that is CRR NDTL is 25,000 crores, then you may have to maintain at the rate of 4.5% per day, 1125 crores. And to avoid penalty, at least minimum 90% should be maintained. And there are also some doubts were asked by some students. This is at least you have to maintain at the rate of 1125. 100% you have to maintain daily. But at least minimum 90% means to avoid penalty, you have to maintain at least 90%. That is at least minimum. If it goes down that, the penalty will be attracted. But this is the amount to be maintained. And that for a fortnight basis, 14 into this much is the total amount to be maintained. This is the point that you have to bear in mind. Just watch it. Suppose a bank has defaulted for 3 days by 275 crores. For the first day of default, 3 plus bank rate, I told you 6.5. First day of default for the amount of default, that is only for the default amount of 275. And if the default continues, it will be 5% above there. This is how that has to be paid. And this is two-way liquidity.
Both on the default amount.
For the default amount, yes, default amount. But here also bear in mind the reputation risk is the largest one. That is the more damaging one is the reputation risk. You have non-compliance risk is that will be affecting the credibility of the bank. That will attract so many negative factors. And if a liquidity corridor, what is a liquidity corridor? This is a liquidity corridor. Now that actually this is a very, very important because this I think it came into effect by the Dr. Raghuram Rajan was the RBI governor. We see that now the fund is available in the money market. You can surplus fund, you can lend it. You are short of fund, you can borrow from the lending market. So interest is the main that factor that decide in the interbank either borrowing or lending. So now that under repo it is explicitly stated by Reserve Bank of India, it will be 5.9% and reverse repo at 3.35%. So both the interest at which you lend and borrow is predetermined by Reserve Bank of India. Because of this, the market will not move above this abnormally or below this. So this is a two-way corridor. Upper band and lower band is there, and mostly the market will be moving just like this. We call it as a snake in the tunnel. It will move like this only. Earlier, if it was not there, if you just freely leave that money market, interbank call money borrowings to the forces of demand and supply, it will shoot up like anything because as you know that interest rate risk will be acting here also. Anybody bigger demand and supply. A market is, if the positive funds will be, we call the terminology is market is illiquid. When the market is dry or illiquid, there will be huge demand for Suppose tomorrow the Reserve Bank of India, suppose it's a hypothetical concept that CRR is increased by 0.5%. If a 0.5% means the amount will be more than 80,000 crores, not 0.5%, 0.25%, 0.25% is equivalent to 80,000 crores in the market. So there'll be huge demand of 80,000 crores in the market. The market will be naturally liquid. All the banks will be for after money to be kept with the Reserve Bank of India. Now this is the corridor, means that market is now regulated very well, because I want 100 crores. I am asking, say, Indian Bank. They say that we will give at 6%. I will say that I don't want at 6%. I will better go to RBI and avail 5.9. So many things are there. This is totally, but this liquidity corridor is only that it defines the upper band and the lower band. And the market, the interest rate is likely to move only in and around this. That's the only point that we have to bear in mind. Next is, so this is two-way corridor, liquidity corridor. And capped at already I have said. This is the 1% limit is only for repo with Reserve Bank of India. You should not confuse. So only for the repo with RBI, the 1% cap and the 14-day limit is there. And the rationale began fixing 14-day is purely because of CRR to be maintained for 14 days. And the banks will be raising money, cash, only for maintaining CRR. Okay. And the purpose of CRR and all that already JB would have studied, because it is the money that also they can ask. It is the money impounded by Reserve Bank of India. Suppose a question comes like that. What is the money impounded? What is impounding? It is taken away from the system. And the word will be impounding is the exact word that we use when a counterfeit currency is brought to the bank. Somebody is bringing counterfeit currency, fake note to the bank. And the bank's job is, okay, you have to immediately you have to confiscation we call, or immediately we said impounding is the perfect word. When you impound, that means you ensure that it doesn't enter the system, financial system, circulatory system, banking system again. That is known as impounding. So they can ask, what is the money impounded by the Reserve Bank of India? That is CRR. CRR is the money, because that is taken away from your lendable surplus. That much of amount is taken away from the bank's lendable surplus. Lendable surplus is reduced because of that your demand portion also, the 20% approximately you have to pay, keep that also, that is reduced from the lendable surplus. 18% SLR you have to maintain, that also lendable surplus reduced. So CRR, SLR, demand money, everything will reduce your nearly to 50 to 55% of a lendable surplus. Because of this, the credit creation is controlled. Ultimately, it controls inflation. It is for that the things we are all doing everything. Not we are doing, RBI is controlling everything. And MSF eligibility, I told you 6.1%.
Sorry, what is capped at 1% of ideal? What is this mean for
that
repo?
it is the if you bank want to avail repo, it can avail only 1% of their net demand and time liability. That is the eligibility. Capped means it is limited. Capped meaning is limited to 1%. Suppose you have got only 10,000, you have got 25,000 crores. 25,000 or 250 crores will be your eligibility. Got it?
Okay, it means that if repo is going 4.5 and if the limit is that we can cap with 1%.
No, 1% is the amount. It has got no linking with the interest. 4.5% is the amount that you have to keep there. 4.5% of your liability. This is total eligibility is 1% of your net detail. Whatever is, if suppose your net demand NDTL is 25,000 crores, your eligibility for borrowing under RBI is 1% of 25,000 crores, 250 crores. That is eligibility. Then additionally, by that is against surplus SLR, I told you for availing MSF also, we have to pledge the SLR security. Here the additional, the 2% I told you. The penalty is waived up to 2% reduction. That is what we call dipping 2%. And another thing is, as a treasury, you have got two options. say you want 100 crores badly for maintaining CRR today. You can raise two ways. You have got two options. Number one is you can make a borrowing, CD borrowing. That borrowing will get money. That money can be kept with Reserve Bank of India. So when you make a borrowing, that is a liability. So in your balance sheet, the liability will go up by 100 crores. The cash has come to a Reserve Bank of India balance. Your asset side also will go up by 100 crores. I will repeat once more. When you option number one is you can make a borrowing from the market under CD. Then the liability will go up because it is a borrowing, and the cash has come to you. Your RB balance will go up, so asset also has gone up. Instead of this, suppose you are preferring to opt that raise the fund through repo, you will be pledging the security, that is investments, that is in the asset side, that will come down. It will be debited from your SGL account, and the cash will come to your repo. So here only asset side only will be one the investment asset side will come down, cash will go up. Liability side will not get affected. This is what we call balance sheet neutral. Just for knowing that, that's all. It makes no difference. Already this we have decided, gone through. Then is and Treasury Department, the conventional function of Treasury is fund management and the liquidity management. Liquidity management, wherever your surplus security, interchangeability, three markets in between operation, depending upon your requirement.
Sir, regarding previous slide, what type of questions we can expect, sir?
I have already told you. Then we will discuss in the afternoon. You just note down.
Okay, sir.
Otherwise, it will not finish, madam. But because the two section we have to finish, and we will discuss exclusively. We will spend more time for it.
Okay, sir.
The funds management, for liquidity management, and the meet reservement. Already we have seen CRR and SLR, and asset liability management of the bank. In asset liability management, to make you understand very fast, I will tell an example. Suppose one person is a branch manager of a, say, Bombay branch. Reliance is offering you, say, 500 crores. You have to give a separate rate. We called it card rate. Now you cannot on your own decide. It's a good thing that branch will get a deposit of 100 crores, but you have to contact only the treasury immediately. There they have got ALCO committee, investment committee is there. ALCO will immediately form daily that committee members will be there. Now, if you see that anything, even if it is credit or any risk or anything, will be jointly by a committee. An individual person decision is not there. If you look anything, any pattern is like that, everything will be joint decision. Accordingly, an ALCO committee will be there. They will decide. They will immediately formulate what is the present position of your assets and liabilities. Then they will decide, oh my God, we have got assets, sir, surplus. Yesterday itself we were having surplus fund and we were lending in the market and nobody was there to take. We have ultimately, we could lend only for 1.5% interest. So that is a position. You have got surplus asset. Surplus that is, you are not surplus liquidity is there. You are not able to give loan. You are not able to raise the asset. So when surplus money is there, what is the use of raising additional liability? So we will say that ALCO will say that we do not fund the fund from 500 crores because we cannot utilize the fund unless there is a demand for the asset loan. Then only there is point in raising liability by paying extra. So the asset liability management is a continuous, perpetual, continuous process whereby we know what is the earning done by each and every rupee that you have studied well in the transfer price form mechanism. And treasury will be considered as a service center. They do service for all the customers, merchants, corporates, everywhere. Now that is totally gone. Now it is operating as a profit center. Treasury is a profit center because of the convenience of interchangeability between this freely interaction between three markets: money market, security market, forex market. And because of the integration of domestic and forex treasury, wherever the fund is surplus, wherever in need, we can adjust interchanging the either security, liquidity, investment. So that is that everything is now in the finger control. Then the rupee fully convertible. Yesterday I told you, today we will discuss that in India the rupee is partially convertible because in respect of current account it is fully convertible. What is the current account? It will not, a transaction does not alter the status of the asset. That is a current account. Example is sending donations, sending gift, and trade activities, entertainment, tourism, medical expenses, all are current account activities. When you come to that capital account, what is a capital account? Any transaction will alter the status of the asset, either in India or abroad. I am raising ACB, my asset is increased. I am putting $1 million in America, I am opening an account. My status is altered. These are our current capital account transactions. In respect of capital account transaction, the rupee is not fully convertible. Up to yesterday, I was discussing in under ACB, only automatic route is approved only up to 750 million. In trade credit, only up to 50 million. Above that, we require Reserve Bank of India permission. So that is why VK rupee is partially convertible, not fully convertible. It is not fully convertible. And we are okay, we are slowly moving towards fully convertibility. That is suppose now the answer this they can ask, is rupee fully convertible? No, partially convertible.
In
Answer
ABM,
is
they asked it,
Actually, in ABM, they are asking the question,
what is the
sir.
present state of
they
rupee
asked it.
in
Okay.
India?
Since they asked it there, probable
both-
chances will not be there, but we will not leave anything to chances. We will knock all
Both
the
on
doors, turn
capital
all
and
the
current
stores.
accounts, it is non-convertible, sir.
What?
Both on capital and current accounts.
What? I don't understand. I have been telling not in current account it is fully convertible, capital account partially convertible.
Okay.
Okay.
Okay. Now, because learn that that is enough. Current account fully convertible. You do not require a Reserve Bank of India permission. In capital account, that is why I have written ECB. Only automatic road limits are there. Beyond that, you require RBI permission. So, in respect of capital account, there is a restriction is there, not fully convertible. And integration, already I told you that profit center. And now Treasury is acting as a profit center. Profit center. Now, the functions of Treasury, definitely, there's meeting reserve requirements. Treasury is responsible for maintaining CRR, SLR, global cash management. Wherever extra fund is there, you can make it. How global cash management is possible, we'll just see an example. So that you see that. You see, I can borrow $10 million. This is yesterday we have seen possible question they can ask. What is the overseas borrowing eligibility? Is 10 million or 100% of tier 1, whichever is higher. Yesterday we have seen. Suppose I can borrow $10 million. I will say Forex Treasury, 1% is the interest that I have to pay for 6 months. So this fund, I will ask the domestic treasury, can you make profit? That bank will, the domestic treasury will say, okay, no problem. We will swap this fund, sell the dollar now and buy it after 6 months. So this $10 million will be converted to rupee and this will be invested to CD. That is money market instrument product. You will get 8%. But there is a risk involved because after 6 months, I have to buy dollar and I have to pay back. At the time, the exchange rate is moving adverse, I stand to lose. So exchange risk is there. So naturally, I have to hedge. What is a hedging derivative product? I have to book a forward. Whenever I book a forward, I have to pay a cost for it, premium cost, hedging cost. That suppose we presume it is 5%. So my whole cost is 1% I have to pay overseas, 5% is a hedging cost for booking forward. So my total cost is 5 plus 1, 6. My income is 8%, which I derive from the CD money market. So 8 minus 6, 2% is a net benefit I can make, which we call it interest arbitrage. I will explain once more. I can raise fund 10 million overseas by paying 1%. I can swap the fund to and invest it in domestic market 8%. But here there is a risk. I have to repay the money in dollars, foreign currency. So I am exposed to exchange rate risk. Whenever risk is there, hedging tool, mitigating tool is forward. So when I do for a sell by swap, I have to pay the premium in the market. Hedging cost is there. Assume that is 5%. So my total cost is 5 plus this one. Hedging cost of 5 interest cost I have to pay in US 1%, 6% I pay, 8% is what I receive. So 8 minus 6, 2% is a net benefit. This is what we call interest arbitrage. I am exploiting the interest rate differences in two markets simultaneously for the purpose of making profit. So this is interest arbitrage. Yesterday we have seen what is an arbitrage. This is possible. This is the best example for integration of the market. This is possible because I could raise from the overseas forex market. I can hedge this, transfer this fund and invest it in the CD market. This the interchangeability because of the interaction between the domestic market and the forex market and the money market. I am able to do this profit. So this is an example. This is how the global cash management. Ultimately, these are all. This will help in making profit. Efficient merchant services. We give excellent service to the customer support. We educate the customers. Now, most of the customers, they know better than us. Because most of your clients, you can see retired forex persons, they will be appointed by these merchants, big companies and all. We can see that ex-bankers will be their advisor. And optimizing profit from operations, forex market, money market, security market. This optimization is best example is interest arbitrage. We have seen risk management of the bank as a whole. The treasury has to assist. The possible question here they can ask is treasury. In the treasury, main risk, the main risk is related to, is it credit operations or market? They can ask a question. In treasury operations, the main risk relates to what? Can you tell me?
Market.
Market risk. Correct. Correct. Market risk. This is a market risk. Everything is market related. There is no loan and something. Everything is market related. You are operating in the market, dynamic market. Assist the bank as a whole in ALM. ALM, assist liability management. I was telling an example of 100 crores in Bombay. Because we are maintaining asset and liability management, every point of time we know where we stand asset-wise, liability-wise. That is why we call it management. As actually, if you look at, we are not doing the asset liability management. In India, if you see as liability asset management, because liability already you create some foreign deposits or something. FCNR deposit is already raised, liability is raised. Then you have got fund, and this fund you go for investing BCFC or loans or something. Do actually liability asset management we are doing. And distinct role of treasury is liquidity management, proprietary position, long and short positions, and risk management. And no problem, because this is very important. I will explain once more how you make profit in long and short position. Some persons may have doubt. Of course, we are tight with the time, but even then, this is very important. I will explain that. You see, the question they can ask is, how a dealer take view of the market? Just assume that rupee is now 83. Morning, the dealer comes and see that the rupee is now 83. And he takes a view that the rupee will depreciate. Actually, it will happen 83 point quarter paisa, half a paisa only, it will come. But for making, hypothetically, for making us understand the concept clearly, I am putting as 84. Never in a day the rupee will move by 1 rupee, very, very rare. But for understanding purpose only, I have put it as 84. Actually, only quarter paisa, half a paisa, 3/4 paisa only will be the moment. But for making better understanding, I have put it 84. Now, what has happened to the rupee? Rupee has depreciated or appreciated? Can you tell me?
Appreciated.
My God, rupee has
Depreciated.
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 Rupee, because rupee, the value has come down. For the same dollar, morning I was paying 83. Now, after some time, the value has come down. For getting the same unit of $1, I have to pay not only 83, but additionally 1 rupee. That is why the value has come down, 84. So here, if it is my view, the 84 is my presumption. It is my speculation. It is my assumption. I assume or presume that the rupee will depreciate after some time, because I have got some data that some negative, the report has come, unemployment data has moved up, everything, so many things, let it be like that. In that case, this is my inference. From the data, it is my inference, the rupee is going to depreciate. Then what will be the view? How will you take a position? I will go for long or short, can you tell me? What position I will go for short or?
Short.
I will go for long. I will long because I will buy at 83 and after that I will sell at 84. I will make a profit of 1 rupee. So if in that, this will be the question type. And the same question they can put reverse also. Suppose a dealer is taking a long view, overbought position, long position. What is his view of the market? Dollar will, can you tell me the answer? Dollar will dash.
Appreciate.
Very good. Rupee will depreciate, opposite dollar will appreciate. Same thing. And ulta, suppose the rupee is going to strengthen. Rupee is strengthen. What position the dealer will take to make profit? Short position. Same question. If the dealer takes a
So short means
short
oversold, no, sir?
position, oh yes,
So short
oversold.
means oversold.
I have written
That-
oversold. Oh yes, is oversold. Oversold.
Oversold is the squaring position, sir. That is
Oversold is in the position. Yes, correct. My position is oversold. I have got some sold dollar is more. So I will take reverse view. So this is how only one thing is there. You study one thing, other will be the opposite of this. Just opposite of. Now you have learned, you know it. You need not spoil that understanding. That is enough. Absolutely. That is how we make profit. This I okay. This is okay. Proprietary position. This is known as proprietary position. This long and short position, which a dealer take, presuming the movement of market, speculating the movement of market, either the rupee will depreciate or appreciate, that will decide the position the dealer takes. And the reverse question they can ask, if the dealer is taking a long position, what is the view of the market? Dollar will depreciate or appreciate, opposite, rupee will depreciate or appreciate. Never just jump to conclusion. There will be worksheet will be there, right? Like this 82, 83. Always I advise my students, rupee has depreciated, write it, because on the mental that thing, stress and all, we should not mistake. Just sufficient time will be there. So just rupee has depreciated. Just lock it in your mind. Rupee has depreciated means 83 has become 84. Because so many students after the examination, they passed nearly 8 years I have been taking the classes with IBS. And always after the examination, I interact with the students. They tell me, sir, when the depreciation came, actually this slide came to my mind, sir. I was immediately, as I told you, I wrote, sir, 83 will become 84. Okay, then you are having a good grip of the situation. Then you go ahead with the question like that. In LC also, the people, so many students tell me, sir, that slide was in front of my eyes, sir. So when they were asking that, who is the negotiating bank, advising bank and all, suddenly that blue screen came to our mind. That helped a lot. That is why I also follow the same pattern so that it will be helpful for you. Of course, you are having a different angle, mean no problem, you can continue. And only telling whatever that has been, that inference I have received from the students. So this
Sir,
is how they
always,
make profit is.
Sir, rupee is depreciated 83 to 84. How you told long, sir? Long buying. How will be identified this is long position?
You see, now this is not. My morning I came, my view of the market is that rupee will depreciate. That means after today, right now, morning 10 o'clock, it is 83. And after some time, it will become 84. Based on some market inferences. So many things are there. Data is available. So many factors are. If you go to the dealing room, it will be full of so many screens. Right, data will be there, Bloomberg data will be there. So many data will be there. You understood this part. Morning I came, this is 83. And after time, I presume it can be wrong. But for the timing, it will be, I have got understanding that rupee will depreciate. Okay, this part you understood. So in that event, what is my best way to make profit? I should take a long position. I should buy dollar now at 83 and sell dollar after some time at 84. I buy dollar at 83 and sell at 84, I make a profit. So in a depreciating scenario, a dealer will prefer to go long. That is the only point statement. In a depreciating scenario of rupee, a dealer will prefer to go long to make profit. That's the only thing. You just coolly think of it. You will be never confused. These are all different things which you come across, not daily. So just to see that, you will be familiarizing. Don't worry at all. This is proprietary position. I told you these are the possible questions, long and short they can ask. Risk management, assist the bank as a whole. Then, and another question they can ask, what is the purpose of ALM, merchant book, trading book? Definitely there will be 1 or 2 questions on this. And by the, when we tell it is a ALM book, it is not a book. That is just like our unruled or ruled book. It is not a book. It will only the meaning by book. What we mean is we are having a system to record continuously, perpetually the state position of our asset and liability of whole bank. The whole bank is position is available because of the maintenance of AL book. This is for internal risk management and also liquidity management. Well, because the example, we will recall that advance, that example, on Bombay 100 crores was received. Only because the investment ALCO committee, they were maintaining the ALCO book. At consolidated, they know where we stand. The bank was standing asset-wise, liability-wise. They could take a prudent decision. We don't want the deposit because we are surplus with liquidity. We are unable to raise any assets. Loans are not being able to be given. So that is a benefit of asset liability management book. And similarly, merchant book, the client related transaction. Merchant book is because of the maintenance of merchant book, you will know what is the merchant transaction profit. And normally merchant transaction, there will not be any loss because there is no speculation. Sufficient margin is added in merchant transaction. How you make profit in merchant transaction? Can you tell me? Yesterday we have learned. By adding that it will be either a purchase or sale. You adjust your commission on any transaction. That is how we make profit in merchant. Sufficient cushion will be there. So there will not be any loss in merchant transaction. But in trading, this trading is very, this is playing with fire. The long and short position making it is just like playing with fire. You have to take it. That is why professionals, experts are being posted in treasury. Trading book is same transaction related to proprietary position. That also, now that because of the computer, everything is captured. So individually, where we stand asset-wise, liability-wise, where the merchant transaction-wise, turning-wise, in trading book also, where we stand in our position, how much profit we have made, or how much loss that incurred. Everything is possible only because of these maintenance of this book. So these 3 books will facilitate, will enable or help you to assess all these things for a better function of the bank. And actually 1 or 2 questions, because comprehensively you have an idea, that is enough for you to answer that. That is enough. And what is globalization? Because opening the doors of global, in the domestic market to the global market. Because then the free flow of capital will happen. Not only the free flow, but the regulatory, Reserve Bank of India's intervention will be minimal also. Now we are in capital account, only the restriction is there. In respect of current account, free flow can be done. Whatever be the amount of remittance, trade remittance, import or export, you need not refer to Reserve Bank of India. Then impact of globalization, deregulation of interest rate, that is capital. It is interest is a factor that makes the capital flight. And new institutions have come because of the globalization. SEBI, IRD, CCLD, this, CRISIL, anything in our rating and all, we go and see the rating. Based on the rating only, we do it also. Any foreign person who want to make investment in India, you will go by the rating. Or what is the rating like that? Then only you will come. And overseas eligibility, already we have discussed umpteen number of times. Then why the treasury is a profit center? Treasury is operating in the interbank market. How that enables profit? 3 points bear in mind. Treasury is operating in interbank market. Since it is interbank, the risk is low. Since the risk is low, the volume is more. Since the volume is more, profit is more. Let the question come in any pattern, you will be able to answer. I will repeat once more. Since treasury operates only in interbank market, the risk is low because these are all banks. Since the risk is low, you can afford to make more turnover. More turnover result in more profit. That is how the treasury becomes a profit center. Possible question they can ask is why the treasury makes huge turnover in the interbank dealing? Because interbank dealing the risk is low. And how the profit is enabled in treasury in interbank transaction. Being interbank transaction, because of the credits, the risk is low, it enables to do more volume. Like that, they can interchange. But you bear in mind this 4 point, whatever is the question, you will be able to answer. Interbank market, low risk, more turnover, more profit.
So
This only for is
low risk always low interest, sir. High risk, high return, sir.
No, low risk means because of the low risk, you will be able to do more turnover. More turnover means more profit. That you need not increase the interest for the profit. Now the strategy is totally different. You go to that ICICI Bank or STFC, ask for the loan. You say, I want 100 crores, I will pay you 1% interest. They will say, we will give you 500 crores. The interest is only 0.5%. So the turnover will result in more profit, not the interest rate. If suppose I give you 1 lakh rupees and you pay me 15% interest, my interest is limited to 15% on that 1 lakh. Instead, what I will do is, instead of 15% interest, I will lend more money in 10%. My turnover will be more, profit will be more. So that is the difference between profit and profitability.
Okay, sir. Okay.
Okay, right. So banking is the most interesting thing, because unfortunately, I have to hurry because of our time constraint, but that is enough. Now that few hours to the exam, this is more than enough. Have an understanding of the subject. Never be cool. Never have tension. These are the things that we know. With the things, present it very well. Okay. High volume of business with narrow spreads. You will be, because of the low risk factor, this enables. High volume will result in, because of the high volume, you can afford to give a narrow spread, minimum margin. Otherwise, they will not be. Suppose I 1 lakh, I cannot give for 0.25%. Only if you are taking 500 crores, I can give for 0.25%. So that turnover will make huge profit. Actually, these are all very pertinent points, because these foreign banks are all attacking Indian market because of this. And small banks will not be able to function because of this. That is why RBI is going for consolidation. Hereafter, just like foreign bank, only few banks will be only able to function, because we want a competitive in an international global market. Earlier, our banks were confined to local market. Each state was having their own bank. Then it has become region-based banks. Now it has become all India banks. Now it is becoming global bank. So that is the order of the day. You cannot help it. Say small banks, they cannot function because their cost of operation, so many things are there. I don't want to deviate. Okay, right. So this is then highly leveraged activity. What is a leverage activity? Because you know what is a capital adequacy now? That is related to risk factor. So the capital charge is, say, suppose I am giving 10,000 crores loan to in a branch. There the risk is more. My capital charge will be total 11.5%. But here in a interbank market where we are dealing, same 10,000 crores, and my capital charge will not be 11.5. It will be lower. So that is a benefit available leverage activity. And also I will be lending to the other banks, not my fund. I have got eligibility to borrow. I will borrow money from A bank. I will lend this money to B bank. So that is my leverage available. Because of this leverage available, my capital charge of 11.5% is low. So that enables me to do more turnover, that results in more profit. The possibility is the return on the question will be return on capital in the treasury is low, Because return on that's because of the leverage benefit. Because low risk is there, you need not capital charge is low because the risk is low. Already you would have studied in risk module. I am not elaborating that. I am only explaining what is a leverage and how that leverage helps treasury to make more profit. Low operational cost because treasury is handled by only few experts are there, professionals are there. They will be doing more turnover. Suppose the one person will be doing a turnover of 1,000 crores, but for doing 1,000 crores in a branch, so many persons, field officer, cost, everything is required. Then source of, yes, you got anybody has got doubt?
Sir,
Sir, please once again
May
explain leverage.
this-
Leverage is the benefit that you get because of the operation in the interbank market where the risk is low. Since the risk is low, the capital charge is low. Already you would have covered it in the risk module. You should be an expert on this. You should be knowing more about the risk than me. I do not know much about the risk management. Only treasury, IB only I know. You will be an expert in that. That is the leverage available. Benefit available. Capital charge is very low because risk is low. Our capital charge is related to the risk only. That you know that. So this is the leverage available. Further, I am handing the fund, not my fund. I can borrow and that fund I can utilize for the lending activity. So this enabled, this a benefit available, advantage available, leverage available. Because of that enables me to do more turnover, which result in profit. Then conventional sources of
Sir,
profit.
I have a question. The high volume of business with narrow spread. Spread is profit, na?
क्या खराब हुआ?
Spread is the profit, 1/4% interest.
So
I
why
was
the
referring.
profit will be narrow? Narrow means the profit will be low.
Profit will not be, madam, profit is 0.5%. My spread is means my 1/4% interest. I do a more turnover will result in more profit. Instead of giving 100 crores in 10% interest, I will give 1,000 crores in 5% interest. So that is low spread, more turnover. That more turnover will result in more profit. That's what I told. Profit and profitability are different. You got
Okay.
it?
Ji, sir.
Because more turnover, now that is how now presently the market is attracting like that. I will tell them because so many cases are there. If it is in the normal class, we can go for discussion. But unfortunately, this is not the time. But since having you asked, I will explain. I don't want to what is this spoil your natural enthusiasm. I will not ruin it. I will explain that. But the market share, who is having maximum market share in housing loan? Who is having the market share? Is it SDFC?
SBI.
SBI? Now that is SDFC has overtaken that. Earlier SBI was having nearly 38%. Now that is overtaken by SDFC. How that has happened? Can only one answer. Simple. Why the SDFC has grown?
Rate of interest.
Whether the SDFC's rate of interest was lower or higher?
Higher.
No,
Lower,
it was
sir.
lower.
Lower.
No, it was lower. It was lower. Because of the lower, if the spread was lower, they attracted more volume that resulted in more profit. You will go and take a loan where the interest is low. And why the STFC was able to give a low interest? That is the MCLR. They were having low cost fund they could raise, current account they could raise, CASA deposit they could raise. So many other factors are there. Because of that, they could afford to give the loan at narrow spread, which enabled high volume that has eaten away the share of SBI. And that too, they are merging of the IDBI Limited, IDBI Housing and IDBI Bank has merged. So many things are happening in the market. Okay, right, because we will deviate. Oh, then conventional Forex business, we make profit. Already we have explained by commission. Money market deals, investment activity may make profit. This area, another question they can ask. We will make investment both in SLR and non-SLR. Sorry, our time is up to 8 o'clock, isn't it?
Yes, sir.
Our time is 6:30. Okay, 8 o'clock, right. both, because I will forget about the time when I enter the class. Both SLR and non-SLR. Often bank will be making investment only in SLR because we have got the commitment, requirement, statutory requirement. Why we are going for non-SLR? Non-SLR are securities just like mutual fund, stocks, shares. There the risk is more or less?
More.
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 When the risk is more, return is
Profit
more or
is
less?
more.
Return
Profit
is
is
more return, yield is more. So for averaging, to increasing your yield, to bring your yield up, we are just making investment in non-SLR. But here, in non-SLR, another question they can ask is, you can go only up to the level prescribed by your board of directors. Because this is a higher risk and all, more risk means more return. Risk related return, already that also risk management module you have. But risk is the most interesting thing because you should be an expert in the risk. Another 3-4 years, the potential for risk management will be more and more. Now itself it is attracting so many positions. So that the risk, you should not be afraid of the risk. It is actually the risk area is an opportunity for you. Okay, non-SLR, coming back to this, non-SLR's investments are high risky. So the return is more. To increase your average yield, we are investing in non-SLR. The restriction is only up to the earmarked by the approved by the board. Only to the limit approved by the board. That's the only point. Then contemporary, already interest arbitrage, trading, speculative activity, long short position, depending on market. That long and short you do depending on the market condition, whether the rupee is depreciating or appreciating, market movement, security, equities, credit instrument, everything we make profit by better dealing. Then front office, back office, mid office. Yesterday we have seen, so we are not again repeating that. These are all theory only. And money market products. In forex products, already we have gone through what is called today or cash, term, spot, forward, swaps, principal, interest swaps. I will discuss. Arbitrage, already we have seen. Interest arbitrage also we have seen. And foreign currency loan, PCFC loan, yesterday we have seen. Rediscounting out been interbank advance and all we have seen. Then this circular has, that is, these are the treasury domestic products. Yes.
Sir, yesterday you told arbitrage is for profit, earning profit, and swap difference was?
That purpose is different. That is for gap adjustment swap.
Okay. Okay, sir.
Right. And this is the market product, domestic. Yes.
So this future means that, sir, this futures.
Futures will come. Next class will come. Next, that means next session we will be doing it. And yesterday, so many persons were asking derivatives, call option, put option, examination, they will be asking. So we will take more time for discussing that. Okay. These are only pure simple things. By a single reading, you can easily understand. Call money, notice money, term money. One questions will be there. Question will be notice money related to period. They will be asking 2 to 14 days. Term money, they will be asking. It will be more than 14 days to 1 year. So just match it with the period. And these are all the eligibility for call money, term money, these operations. Because I will share that, no problem. And this is the treasury bill is a market. Definitely 1 or 2 questions will be there in treasury bills. This is the period 91 days, 192, 364. And always it is issued the discount. And always they ask, it is in Reserve Bank of India or Government of India security. Treasury bills is a security issued by Government of India, owned by Government of India. Only the issue is managed by Reserve Bank of India. This also is held in a SCL account. It is an SLR approved security. Then 2 types of allotment is there: uniform pricing and multiple pricing. Uniform is it is done by bidding. Uniform is and accept one. Suppose a bid is accepted, everybody will be given at the accepted bid. That is a uniform price. Multiple is I have quoted 98. You have quoted 96, 97. I will be given at 98. You will be given at 97. Respective bids. This is common. Suppose a 98 bid is accepted, everybody will be given 98. Then implicit yield is a calculation, is that simple interest formula. I will tell the example. What is the implicit yield of a 91 days treasury bills? This is a period is 91 days, and you have issued at 91. You have, this is at a discount. So you have bought at 1991. After 91 days, you will get 100. So the formula is what is the return, or we have to find out. P principal, you know that this is the principal 98, 91. N, you know 91 days, or we have to find out. You rearrange that formula, R will be 4.42%. This is mathematics. Only you will have a doubt, which I am explaining, from where this 1.09 that came. That rate, that is the interest. The 100 you will be getting. Now you have invested 98.91. 100 minus 98.91 is 1.09. 1.09. So this is the interest. This is the interest that you is 1.09. So interest 1.09 you know. Principal you know 98.01. N you know 91. Then it is up to you to find what is our 4.42%. This is only a school level mathematical formula. Especially AFM is over, you should be an expert in even present valuation and all. Present value concept, future value concept, you are all masters. So this will be a jujube for you. Another thing, one question is treasury bills that is falling due on 26th January will be paid on which date? Any principal that is due falls on a holiday, it will be paid on the previous day. So 25th January, it will be paid. You learned that there will be a question on it. Any investment due, if it is falling on a holiday, it will be paid on the previous day. Another question, and interest is falling due on a holiday. When it will be paid? It will be paid on the, can anybody tell me? Very good, very good. Because I presume that you will be answering succeeding day. Next working day, very good, next working day. So principal amount falling due on a holiday will be priced on the previous day. Interest will be paid on the next day. So that is a general pattern. This is an example. You see how uniform. Suppose a bank, or Reserve Bank of India is giving a auction for 10,000 crores. In a uniform auction, naturally IO has quoted 9850, Canara Bank 9849, 4847. Suppose IOB has quoted 9850. This is the most profitable. So RBI will accept the bid 9850, and it will be giving 9850 to all the price will be the same till the 10,000 crores is achieved. Here 2,000, Canara Bank they will give at 98.5 thousand crores, total 3,000. Bank of Baroda they will give at 98.50, accepted bid 2,000. 2 plus 1 plus 2, 5 crores. SBI has requested 7 crores. Balance out of this 10,000, 5,000 is gone. Only 5,000 is there. So 5,000 crores they will give at the say 98.50. If it is a multiple auction, 2,000 at this price, 1,000 at this price, 2,000 at this price, respective bills. And this cash management bills, only that question is, it is just like treasury bills, only the difference is it is for a short period, less than 91 days. Commercial paper, definitely question will be there. What is a period? Period is 7 to 1 year. This is a period 7 to 1 year. And the rating is either A3 or P3 rating. Next question they asked was the amount was 5 lakhs. Minimum amount is 5 lakhs and multiples. Now the financial institution can up to 1 to 3 years. Only I am giving you the data. This also I am already have shared, but again also I will share. But what is the point that you have looked at? Never read from the slide. PPT is only for just understanding, but you have to study, read only the notes. And certificate deposit, the change which has come easily, earlier it was 1 lakh, now it is changed to 5 lakhs. And the period also 7 to 1 year. And the change which has come as per the circular is loan should not be given against CD, and it attracts stamp duty, it attracts CRR, SLR. NRIs cannot invest in CD. That's a change that has come. And repo already, reverse repo, MSF already we have seen. CBLO or TREPS is nothing but the repo of CCIL. The repo of CCAL is what we called CBLO. Now the CBLO, the name is revised to TREPS, Tri-Party Repo Dealing System. Yesterday I was quoting an example, State Bank of India, Indian Bank and CCAL. I was telling you that is a contract novation. As per the contract of novation, that three parties will be there. So that is documented. Borrower will be there, lender will be there, CCL will be there. That is why now it is, instead of CBLO, we call it TREPS. And the amount also, they will, minimum lot size is 5 lakhs and multiples. 5 lakhs and multiples. Bill discounting also is an avenue, does not require any explanation. And government securities, this is very important. Definitely some questions will be there. You see, we can enter investment portfolio, we have to bifurcate in three ways. One is held till maturity. You need not provide, because you are going to hold that security till maturity. You will not sell it halfway. So provision is not required, because you will get the face value at the end. Maximum limit is whatever is SLR is 18%. So up to 18% you can go in investment in HTM. Now they read that is additional data, because every bank has reached 18%. But the government want money, they are coming with government flotation. So RBI changed that. You can hold security under HTM even more than your SLR requirement. That is why this is increased 19.5, 22%. So that banks will buy government securities and keep under this. The return will be more government securities. You need not provide depreciation. That is, no marking to market means you need not provide. So this is the two benefits. And premium to be amortized. Suppose I am buying a security 100 rupees at 110. On redemption, I will get only 100 rupees. The 10 rupees is a loss. Suppose the period is for 5 years. Every year I will be amortizing, debiting to my PLN account, interest account, 2 rupees. So that at the end, my book value will be 100. I will be getting 100. These are all really arithmetical things. And after the STM, this is HFT. This is for possible question they can ask is deficiency period. 90 days they will ask. What is the deficiency period? This is once any security, bonds or debentures held under that HFT, you should sell it or trade within 90 days. You should not indefinitely hold that. Within 90 days, you have to sell the security. This 90 days is the RBI prescribed amount, deficiency period. If the bank's board of directors decide, this period can be lesser than 60 or 30 days as the bank deemed fit. So that's a deficiency period. Here marking the depreciation provision should be daily. Stop loss, the limit should be fixed. That depends upon again the risk appetite of the bank. And this also, any security that is not coming under STM and AFT, that will be classified under available for sale. Example, that will be best example, non-SLR and mutual fund or equities. Here quarterly you have to mark to market. Now that the RBI has enabled shifting of the securities, interchanging from this at the board accepted intervals. Normally will be done at the year beginning or year end. So that if you are not having, I will only one question I will ask. Possible question they can ask is long dated security, security that is maturing after 10 years. Under which category you will categorize? STM, AFS or ASF? If you answer that, that means
HTM.
STM. Okay, very good. Correct. Can you tell me why you have classified as STM? Your answer is correct. Why you have preferred, opted to classify under HTM? Can you tell me?
That much profit, interest we are earning for the 10 years.
There is no MTM.
Very good. That is, but you are indirectly the profit is correct, because the return is more because it's a long dated security. It will suffer maximum depreciation. So you need not mark to market. So you can save. So not only that you need not provide depreciation, but also you enjoy the high return. So that is why long dated securities are classified. Next question, non-SLR investment, where you classify, they can ask. And deficiency period also they can ask. Enough, no problem. And corporate debt paper also, much questions they will not ask. Read it. These are all very simple only. Debenture and bonds, differences I have given. Bonds, convertible. Convertible bond, they can, possible question is, why this is a hybrid, they can ask. Why convertible bonds are hybrid? Because it is a convertible. You will be converting to stock, then you need not repay. But if you don't, the party does not opt for conversion, it has to be paid back. Since it has to be paid back, it is a debt. If it is converted, it will become the equity. So since it is a mix of debt and equity, we call it as a hybrid. Second question they can ask is, when a person will opt to convert? When a person will answer is, already you have got a pre-fixed price. Say example, the company says that this share, this will be converted at the rate 9090 rupees. On the day of conversion, when the period comes, whether a person will opt for conversion depends upon the market rate. If the market rate of the share is 93 rupees, more than that, it is better to buy, convert at 90. So if the market rate is, if the rate is favorable or the market is unfavorable, more than this, you will opt for conversion. That is the point. In another question they can ask is, in convertible bond, in what way it benefit the company? Second, they can ask. Benefit is that it need not repay that. Fund outflow is not there. There is no liquidity payment. There is not payment is not there. So you are saving that liquidity. And also it is converted to equity stock. So your equity base is also wider. It is just like bonus shares. Bonus shares. Instead of paying the dividend by cash, you will be issuing bonus shares. So your share that turnover also increases. That is equity base is widened. And also there is no outflow of payment. In that way it is safe. ADR, GDR also already we have discussed.
Excuse me, sir. This MTM expansion, sir. MTM.
Marking to market, provisioning. Marking, that is a technical term. Marking to market means you are providing the depreciation. You have bought a security is 100. Today it is 98. 2 rupees is a market dip has come. 2 rupees you have to provide from your profit. Depreciation provision. That technical term is, we call it as marking to market. Then the two rate of rates are there. I told you the floating rates we will discuss today. Fixed, what is a fixed rate? That remains fixed till the period of the loan is closed. During the course of the loan, it will remain fixed. Floating is, it keeps on changing along with the benchmark rate. Benchmark rates are this as overnight rates, term rates. And term rate is normally for 1 year. Only for RBI, it was 14 days. Now that LIBOR I told you has gone, instead SOFR has gone, secured overnight financing rate. It is for dollar denominated loans. It is an overnight cost for borrowings under repo in treasury. In British sterling, this is the most important. This has replaced the LIBOR. Sterling overnight interbank average rate. You study this Sonia rate. Sterling overnight interbank average rate is a rate that has replaced LIBOR. Now the benchmark rate, any foreign currency loan and all, instead of LIBOR plus 50 basis, LIBOR plus 3%. Now that it will be Sonia plus C% or any other benchmark rate. In India, we are following this FBIL. FCNR deposit, yesterday I told you, ARR, alternate reference rate. I wrongly wrote at ARR, some person promptly corrected me ARR. So alternate reference rate, this also they can ask, because now the as it is given by FEDI. Now FCNR deposit earlier was LIBOR, now it is based on FCNR LIBOR. Instead of LIBOR, it is ARR. This ARR is punished by FEDI. Then Financial Benchmark India Limited. I think this also I wrongly told as FinTech. It is not FinTech. It is Financial Benchmarks India Limited, FBIL. And this is a joint venture of FIMTA, FEDI and IDEA. They are giving the rates, term IBOR, certificate of deposits, etc. Okay. Now.
So this SOFR is for MIBOR?
Not MIBOR. MIBOR is different. MIBOR is in India. This is international. These are this is an international benchmark. MIBOR is, you are correct.
Mumbai based something like that.
Not something. We will learn Pakka. Mumbai Interbank Offered Rate. MIBOR. That is a benchmark rate for loans related.
Internationally, we use Libor, na Sonia, which is Sonia.
Sonia, Libor is not there. Instead of Libor, we will be using only Sonia. Okay. Depends on the bench, because it depends. The benchmark rate can be anything. Depends upon the convenience. Now we have got 3 questions. Please. Okay, only nothing. You got any?
Sir, what is the main difference between forward and swap, sir?
My God. Forward is booking a forward mean you are guaranteeing a rate for the future. That is forward. Swap is nothing, only the gap adjustment. You get fund now, you require after 1 month. I will say I will give the fund, you give me after 1 month. That is swapping.
The HTM, which is better? Matlab HF for mutual fund or all this, but first or last is for?
Last for trading securities. You make profit only through trading, that should be under that category. That is why the RBI has specified that you should not hold more than 90 days deficient period. Because speculation, trading should be done, but you should not utilize for speculation. That is why the restriction. And small slide is there, we can easily finish. Here that funding and regulatory, already we have gone through CRR, SLR. Only 2 terms you have to study. M1 is narrow money. That is current. What is the components of M1? Already in economics you have studied that, you repeat. That is enough. M2 is saving deposit plus post office. M3 is broad money. M2 plus this. For components of M1, M2, M3, you just study that economics. That is enough. Because country to country it will differ.
Sir, what is the main difference between
Sir,
M1 and
M1 plus no, sir.
Which one?
M3.
M3 is M2 plus. M2 plus this time deposits.
M1 plus, sir.
No, actually we studied earlier M1 plus time deposit with the bank.
Okay, then because these are all internationally, this will go on changing with country to country. So whatever that you have, that is why we have decided, because mostly they are asking only economics base. You study, go by that. That's why I told you that. But I will, there will be a skip on if it is
called as broad money, but M3 is
okay.
M1 plus time deposits with banking.
Okay. Instead of this, you take that, no problem.
Okay,
I 100% agree with that. But there will be missing that academic interest. I will verify. Here, my point is only what is narrow money, what is broad money. That is what I want. And what is a multiplier effect? It is M3 divided by broad money divided by narrow money will be the multiplier effect. So RBI has got some accepted levels, nearly 6 or 6. That will be varying. They will not ask it. So that is for controlling that inflationary trends. At present, we can see that RBI has adopted so many measures for the inflationary trend. Now the rupee is just passing that benchmark level of 6%, we can see. And these are all payment settlement. Already we have seen. And payment settlement, RTGS, Infinite is India Financial Network. It is a communication network developed by IDEA. This one word they can ask. Objective.
Sir, in ABM, one question came, sir. Payments and settlement is governed by
PSS Act.
NPCI.
No. RBI is the answer. Only operated by NPCI, governed by RBI.
Very good. Oh, very good. Excellent. Thank you. You see how beautifully they are framing the questions. You see how beautifully they are. It is controlled by which act means PSS Act. Very good. Correct.
We all wrote NPCI, National Payments Corporation.
Even I wrote NPCI, sir. After coming and I cross-checked, it was RBI.
How was the question? Because I will include it in my...
Question is in 2 lines, sir, that question.
What was the question? Can you repeat? This is really interesting.
NPCI is governed by...
Sorry,
Payment and settlement systems is governed by...
PSS is governed by...
options are RBI, NPCI, CICIL, none of the above.
PSS is governed by, answer was RBI.
Sir, one more question, sir. The difference between
NPCI, sir,
and M2, sir.
PSS is governed by National Payment Corporation. Okay. But naturally the tendency will be for taking RBI, isn't it? Okay, what was another question?
Sir, one question I could recollect right now. This market stabilization scheme, what is it used for? It is to inject liquidity or it is to absorb the liquidity. So what is the right answer, sir?
Stabilizes, both will be the answer.
Actually, two options was there, sir. Market
Only two.
stabilization scheme, whether it is to inject the liquidity into market or to absorb the excess
Then we'll
liquidity.
go for the absorbing the liquidity.
I also wrote the same.
Okay.
So,
okay.
Okay.
Because it's only tossing the coin head or tails.
Okay.
Okay. Then RT Infinite is India Financial Network, and the Institute for Development is in IDRBT is in Hyderabad. SFMS also, it is equivalent to our SWIFT messaging system. The India Financial Network is a system, that is a messaging system developed by that is structured financial system that's developed by Infinite. This is on the platform, these messages are running. And this NDS negotiate dealing system they can ask is an electronic platform for putting through government security trading. It is also managed by CCIL on behalf of Reserve Bank of India. Now NDS is order matching we call, because of the transparency. If I want to buy a security, I will quote my bid. If another bank is ready to sell that security at the same bid, then it will be matched. Then settlements will happen. The system now is known as eKuber, FX Clear, CCIL, NSDL, and NEFT. Okay. Then this is actually this already in the ALM you would have covered. I'm not giving gaps and all. Interest rate risk, sensitivity ratio, these are all repricing risk, securitization. This also you would have. Then here securitization question they can ask is what is PTC they can ask, and what is special purpose vehicle also they can ask. Under the securitization, that suppose a company is going for liquidation or has become NPA, say they have got 500 crores advance. Another company will taking over that. Example, Godrej. They will take over this company by giving the 500 crores to the bank. This 500 crores invested by the Godrej, they will get it from the market by issuing the PTC. This is just like units. Say 1 lakh units of say 500 crores mean say 50,000. So this will be traded in the market. I will invest, I will take one PTC, invest 1 lakh. I presume because Godrej has taken, the price will go up. If it goes up, I will sell it in the market. An agency which is managing this PTC, issue of PTC, is known as special purpose vehicle. Credit default swap also swap, because it's a adjustment credit. That is, this is a derivative. As you know, suppose I got a loan, what is a credit risk? Default in the payment is a credit risk. So somebody say that risk is swapped by him. In case the borrower does not make the payment, he will make the payment. So I am protected. My credit risk is hedged by this tool. That is why the question will ask. But since your risk management not problem, these are transfer price mechanism. Transfer price mechanism is already that ALM you would have covered that, even then I will tell. The ALM is that is you are getting fund by way of liabilities in the branch. This fund you will be giving to your head office at a cost. Likewise, for investing in assets, for giving loans, you require the fund. That fund you borrow from head office at a cost. So there will be a cost from the head office, and the price at which actually you do. The difference will account for your profit. Difference will account for your profit. My God. Profit. I think 8 o'clock.
Sir,
we'll
M1, M2, M3. Sir, can you want to enter M1, M2, M3?
M1 again, you just totally discard this, madam, and go by that economics class, M1, M2, M3. But what is it? Because if you want the theoretically the explanation of M1, M2, M3, what is the purpose? I will explain. M1, M2, because there always the money is in circulation. Reserve Bank of India has so many tools in their armory, like we call it monetary aggregates. M1, M2, M3, M4, M5. It goes L1, L2, L3, L4. These are all called monetary aggregates. What is a monetary aggregate? These are all measures or tools for the Reserve Bank of India to measure what is actual money in circulation. What is a narrow money? What is a broad money? Because based on this only, they will be able to assess what is the credit money in circulation. What is the purpose of RBI to assess all these things? Only if the credit money in circulation is assessed, they can assess what is the actual the credit money, whether that is the over credit creation will happen. This credit money in circulation will trigger credit creation. This credit creation will ultimately result in inflation. So these are all tools effectively to control the ultimate inflation or deflation. So with that only we'll be able to infer where we stand. So it is for that purpose RBI monetary aggregates M1, M2, M3. These are we just our terminology you should familiar narrow money and broad money. Can we break and assemble at 9:30?